The financial system of China is one of the most studied subjects in modern economics because it blends old traditions, state guidance, global ambition, and rapid change. When we look at the structure and function of Chinese banks, we see a system that serves as the financial engine of a vast economy while also responding to national development goals. In this lecture-style text we will explore the evolution of banks in China, the major institutions, the regulation framework, the relationship between the state and the financial sector, the challenges that the system faces, and the reasons that many analysts continue to watch Chinese finance closely. To understand Chinese banks today, we need to look first at the historical background. Banking culture in China is not new. Traditional money shops existed for centuries. They handled deposits, loans, and transfer services for merchants across regions. However, the modern banking system began to take shape in the 20th century and especially after the founding of the People's Republic of China. For many years after that time, banking in China was centrally planned. Credit was allocated according to national priorities. Interest rates were fixed and competition did not exist. This period shaped the mentality of banks as institutions that must support broad development tasks rather than simply pursue profit. A major change took place when China began market-oriented reforms. Banks were asked to operate more commercially, yet they still had to serve national development plans. As a result, the banking structure became a mix of commercial purpose and policy direction. 4 large state-owned banks played a central role in this period. These institutions include the Bank of China, the Industrial and Commercial Bank of China, the China Construction Bank, and the Agricultural Bank of China. Each has a distinct historical mission. For example, the Bank of China traditionally handled trade-related finance, the Construction Bank focused on infrastructure projects, and the Agricultural Bank supported rural areas. Over time all 4 grew into massive institutions with millions of clients and vast networks. Alongside the Big Four, China developed policy banks. These banks were created to fund projects that serve long-term national planning. They do not focus on profit and they often lend to strategic programs such as infrastructure, energy, or overseas development partnerships. The presence of both commercial banks and policy banks creates a layered system. Commercial banks must balance risk and return while also supporting guidance from the central authorities. Policy banks focus almost fully on national plans. A critical institution in this system is the People's Bank of China. It acts as the central bank and guides the overall direction of monetary policy. The central bank uses interest rates, reserve requirements, and other tools to influence liquidity in the banking system. The central bank in China plays a more active guiding role than many central banks in market-driven economies. Its policies affect the availability of credit in the banking sector and the speed at which the economy expands. In addition to the central bank, there is a strong network of regulators. These regulators monitor banks to make sure that loans are safe, capital levels are adequate, and internal practices follow standards. Regulation in China is known for being strict but also responsive. During periods of rapid growth, regulators often step in to prevent overheating. During slowdowns, they encourage credit expansion to support economic activity. This coordinated approach aims to reduce volatility while keeping the economy on a steady path. Competition expanded as more institutions entered the market. China allowed the creation of joint stock banks which combine state support and private investment. Urban banks and rural banks also grew to meet the needs of local areas. These smaller institutions play a major role in financing small firms and private businesses which have become an important part of the national economy. Foreign banks were also permitted to operate in China under certain rules. Their presence encourages international standards and helps Chinese banks learn from global practices. Technology became one of the strongest forces shaping Chinese finance. China is a world leader in digital payment systems. Large technology firms created platforms that allow instant transfers, online savings products, and consumer loans. These platforms influence the behavior of consumers and banks. In response, traditional banks modernized their digital services to stay competitive. The result is a financial system where digital tools play a central role in everyday transactions. One of the most important tasks for Chinese banks has been funding urbanization and infrastructure. Massive transport lines, energy networks, and housing projects required long-term financing. Banks provided the credit that made these projects possible. This role connected them closely with local governments, because local authorities often initiate construction plans. The relationship between banks and local governments is both an engine of growth and a source of risk. Local governments sometimes borrow heavily to finance large projects. If these projects do not generate enough return, repayment becomes difficult. Due to rapid growth and significant lending, one of the key challenges for Chinese banks is managing non-performing loans. A non-performing loan is a loan that is not being repaid on time. Large economies always face this issue, but in China the problem can grow quickly because the banking system plays such a central role in development. Regulators monitor these loans carefully and periodically require banks to strengthen their balance sheets. China has created asset management companies to take over troubled loans from banks. These companies try to restructure or sell the assets to recover value. Another feature of Chinese finance is the shadow banking sector. This term refers to financial activities that occur outside traditional banks. For example, some firms issue investment products that look like deposits but are not officially guaranteed. Shadow banking grew because some investors wanted higher returns and some firms wanted easier access to credit. While this sector provides flexibility, it also increases risk. Regulators have been working to bring these activities under closer supervision to prevent instability. Chinese banks also play a major role in global finance. Many participate in international markets, support trade flows, and finance overseas projects. Some support large international development efforts, especially those focused on transport, energy, and regional connectivity. By financing projects abroad, Chinese banks help expand the influence of the national economy and deepen economic ties with other regions. Interest rate reform is another important part of this story. For many years interest rates were controlled tightly. Over time China moved toward a system where market forces have more influence on rates. This allows banks to price loans more accurately based on risk. It also encourages savers and borrowers to make decisions that reflect real economic conditions. The transition takes time, but it supports a more mature financial environment. To maintain stability, China frequently uses macroprudential tools. These include requirements for capital, ceilings on lending to certain sectors, and guidelines for mortgage lending. The aim is to prevent excessive risk-taking and reduce the chance of sharp financial shocks. These tools are adjusted depending on the economic cycle. When risks appear, regulators tighten rules. When the economy needs support, they relax them. A major theme in Chinese banking is the balance between control and flexibility. The state maintains strong oversight to ensure stability and alignment with national goals. At the same time, market forces are allowed more room as the financial system matures. This dual approach is one reason that Chinese finance attracts global attention. It represents an alternative path of development, different from systems that rely mostly on market competition. As we reflect on the future of Chinese banks, several questions arise. How will banks handle the demands of an aging population? How will they support emerging industries such as advanced manufacturing and clean energy? How will they ensure credit quality while also sustaining growth? These questions shape ongoing policy debates. Despite challenges, the scale of Chinese banking remains one of its defining features. The country has a vast savings base. Households deposit large amounts of money into banks due to cultural preferences for security and stability. This provides banks with a steady pool of funds to lend. With this foundation, banks can support businesses, infrastructure, and innovation. In summary, the story of Chinese banking is a story of rapid transformation guided by national priorities yet increasingly influenced by market forces. It is a system shaped by history, propelled by development goals, supported by technological progress, and observed closely by the entire world. Understanding this system helps us understand the direction of the Chinese economy and the evolving structure of global finance.